Good evening. Tonight is Tuesday, March 26th. We just did quiz 4, and today I'm going to finish chapter 21, which I started last week. In terms of announcements, there was none. Well, late breaking news I got from the course supervisor. The assignment's going to be posted 10 days before the due date, which the due date I think is April 12th. I think it's at the last class. I got to double check. It's April 9th. April 9th. Okay, the last class is April 9th. That means the assignment's going to be posted March 31st or 30th. So that's the 26th today. I'm guessing the 30th is about Friday. So the assignment's going to be posted on CU Learn and on my website on Friday, so you can get started. Any other questions about anything else? Okay. So last week I did chapter 21 is quite a heavy chapter. It's kind of like 16. In the past, I've tried, when I've tried to teach 16 and 21 within a single week, it never works because it's so rushed. I don't have time to quite explain all the details. And these are 16 and 21. I would call kind of double chapters. They're the ones that. It's not like, say, the one you just did where there's really only a few math problems you can get out of it. Out of 21, there's all kinds of things you can do. Yeah?
It's a general question. For the final, is it going to be like the long answers going to be questions we didn't get quizzed on, and then the short answers being like stuff we got quizzed on and it was on the midterm, or is it going to be cumulative?
Can you repeat your question?
Is the exam cumulative from the beginning?
Oh, meaning like, yeah, the final exam has material all for the entire length of the class. Okay. It's just weighted a little bit more heavily on the second half. Okay. So there's still going to be questions on, 2, 10, 11, and 14, and 15. Eh?
Long answer questions too?
I don't know yet. We haven't made the final yet, so okay. Maybe one, but just in general, there's going to be a lot more weight on the second half of the course. So about 2/3, 1/3. Okay. So about 2/3 of the written questions will be on the second half of the course. 2/3 of the multiple choice, more or less. It's the best I can say. We haven't done because the final exam for this course is I think on the last day or very second last day of the exam thing. So our due date is not till the first week of April to get them to print. So we haven't actually done that. But in general, like I've been teaching this course like 7 or 8 times, it usually has that kind of setup. Okay, so 21 has lots and lots of different material. It's actually less about finance and a little bit more about economics. Kind of macro concepts like purchasing power parity, inflation, just general interest rates, things like that. Those are not so much finance topics, but you need to know about it because when you're doing finance in an international context where you got multiple currencies flying around in your cash flow analysis and your projects and all that, you need to know how to handle those different currencies. So last week was kind of an intro to foreign exchange. The basics. What's a currency? How do you convert one to the other? Then we talked about purchasing power parity was an important topic to start to explain how you look at what moves interest rate over the long term. What I'm going to do is I had gotten as far as 21.4 last week, but I'm just going to restart in 21.4, just a little bit of review to get you back in back in shape here and explain interest rate parity, because that's probably, it's a very important concept to understand what happens with currencies into the future. And the reason why we need that is the reason why we're doing all this kind of prerequisite work is to get into international capital budgeting. So when you have a project, you know, you're opening a new location in a foreign country, or anything where you have the net present value is of a currency that's not the same as your home, your domestic currency. Well, how do you do the currency translation over the life of the project? Because obviously you can't just take, you know, call Scotiabank, get what the exchange rate is today, and then do a 5-year cash flow forecast based on that exchange rate, because that's going to change a lot. So the reason why we need to understand interest rate parities so that we get into how do you convert cash flows which are in the foreign currencies but they're happening into the future. And then the rest of the chapter is some qualitative knowledge. We'll see how fast I can get through that, but we should be done. I don't think we'll have a full class tonight, but I do have more examples, so you'll be free to leave if you want and watch them later on YouTube. So we talked about different types of arbitrage. Just a quick review. Could somebody explain to me what an arbitrage is in general terms?
So, like when there's an opportunity to buy low basically and sell high somewhere else?
Yeah, it applies in different contexts. The way that it works is where you're able to lock in simultaneous trades that create a riskless profit. And what happens when somebody spots that? Well, they just do it all day long, because everybody loves free money. The classic example is the Rothschild family in the UK. There was one brother in London, one in Paris, and the other one in Italy. And what they would do is, the arbitrage relationship that they were looking at was that the price of gold should be the same in different cities. And so if the price of gold was, say, 150 in one city, or say 200 in one city and 100 in the other, what they would do is buy in the city where it's at 100 and sell in the city where it's at 200. Obviously, when you buy something, that raises the price. And then when you sell something, that lowers the price. So they would just keep doing that until the prices were in equilibrium. That was one of the first arbitrage relationship that was found in the world, that the price of a good, which is exactly the same in two locations, should be the same. Because anytime where somebody can come in and do an arbitrage on a price, then what it does is it creates very strong economic forces that converge the price to that common value. And if it ever diverges from anywhere else, then what happens is people do this arbitrage trading and it brings the things back into balance. So that was the simplest type of arbitrage. Just one price of the same good should be the same in two different locations. The second one, I'm not going to recover today, but it was called triangle arbitrage. This is where, think of all the currencies there are in the world, and if you were a bank and you had to imagine, quote, exchange rate between every single pair. Think if you just took the world's top 10 currencies, that would create 100 currency pairs. So instead of having to basically have all the pair-to-pair exchange rate, what banks did a long time ago is they only have exchange rate compared with some major currencies. The US dollar, the euro, used to be the Deutschmark, but now it's the euro, and the British pound. London was the first ever big world banking center, and the other one's the yen. Gold is called the fifth currency. I explained that last week about, has to do with inflation, that gold is a way to, you can keep your money in US dollars or in British pounds or in gold. When you put your money in gold, then people can't print gold the same way you print paper money, and so that protects your money against inflation. So triangle arbitrage was that between the if you have three currencies, let's call it, say, the US dollar, the Canadian dollar, and say the British pound. If C is not equal to A times B, then you have a triangle arbitrage. So that was the second arbitrage that I introduced to you. And this concept of arbitrage pricing is common throughout all of finance because it's an argument for where prices should be. So you're going to see this arbitrage-free pricing in your third and fourth year courses. So I'm just introducing it in a very quick, simple way. If here the exchange rate to go from the US dollar to the Canadian dollar and then to the British pound is different than you could do a direct trade between those two currencies, what happens is you just do this triangle arbitrage thing where you start in any currencies and then you go clockwise or counterclockwise. If the direct rate is in equilibrium with the cross rate, then there is no triangle arbitrage. If it's not, there is, but if you go, say, doesn't matter where you start, once it's not equal, doesn't matter where you start, but it matters if you're going clockwise or counterclockwise. And if the direct rate is different than the cross rates, then you just start one way. It just means that one of the ways is going to create a profit. And if you do it one way and you end up with less money than you started with, then it just means that you do it the other way and you will have an arbitrage profit. So what that does, in this case, it will create forces, market forces on the different exchange rate, and as people do this, it will bring it back into equilibrium. So that was the second type of arbitrage that I talked about. Now, the next one, the first one was quite simple because it was just one number should be the same in two places. The second one is you got three things going on. Covered interest arbitrage is a little bit more complicated because it creates a balance between four different quantities. The spot rate, remember, which is the amount of the exchange rate that you could trade today. The forward F1 means the 1 year forward rate, which means the rate that you could lock in a trade today, but that would settle a year from now. And then the interest rate. This should be RGB there. The interest rate in Canada and the interest rate in the UK. The covered interest arbitrage argument means that there's a certain balance between those four things. And let me show you this example. You saw it last week, but it's complicated enough. I want to do it a second time, so a little bit more clear. How's the lighting? Should I put one more light on, or what do you prefer? You prefer this or that? Prefer this, eh? Okay. So in a covered interest arbitrage, what's happening is this. You have today times 0, and you have a year from now. And so what you do is you start with $100 that you borrow. Then you convert that money into British pounds. So that will be the spot rate is 2 British pounds per Canadian dollar. And so if you had 100 Canadian dollars, then you convert it at the spot rate, you end up with 200 British pounds. Then you take that 200 British pounds and you invest it into at the foreign exchange rate, which is 5%. So you're left with 210 British pounds. Then this is the key point of this. Remember that an arbitrage is where you can lock in all the trades at the same time. It's not that you do this trade today and then a year from now you exchange the money, because the spot rate a year from now might change, might make this trade unprofitable or profitable. But the key concept here is that the forward rate is a rate that you lock in today. So you know for sure that you enter into a legal contract where you'll be able to convert that 210 at 1.8. That will give you 116.67 Canadian dollars. And then what you do is you pay back your loan. Which is, with the interest, will be 110. And you're left with an arbitrage profit of 6.67 Canadian dollars. And so you put up $0, right? Because you borrowed that 100. You invested that 100, and after you pay back the loan, you're still left with a profit. Of course, this is an amazing deal. And so what's going to happen? People are just going to say, wow, I love making free money. I'm going to take this deal all day long. And what it does is it will put pressure on the spot rate. Because you're borrowing money, it will put pressure on the interest rate in your domestic country. It will also do that on the exchange rate in the foreign country and on the forward rate. And so what's going to happen is you need a forward rate. So the ratio of the forward rate, the 1 year forward, to the spot rate has to be equal to the gain between the interest rates. Because if it wasn't, you can make this covered interest rate arbitrage and make free money. If it was the other way, then it's similar to triangle arbitrage. There might be, one of maybe the forward rate, a spot rate, or the interest rate is too high or too low. It might be that you need to do it the other way. If they're in balance the other way, it could be that you start with the British pound, you convert to Canadian dollars, you invest at the Canadian interest rate, and then you also lock in the forward ahead of time to go back to British pound, pay back your loan, and still make a profit. In either case, what it says is that the interest rate, it's not quite the spread, it's the ratio of the interest rates between the two countries has to be equal to the ratio between the forward rate and the spot rate. So that's the argument for why this equation exists. Now remember that there's an approximate relation where if you take this formula and you rewrite it this way, it's actually pretty close. And I got a little bit more time today. I'm going to show. Yeah.
Maybe like a real world setting. Would the cut off the exchange, wouldn't that offset any sort of profit? You know, like let's say you change from Canadian to pounds.
Yeah. Well, the thing about arbitrage is it has to be a riskless profit after transaction costs. But if you think nowadays, the people that are doing that are the banks on their computers. And so they're not really it's almost impossible for an individual investor out of their basement to try to set up these things, because when they do pop out, they exist for maybe 10, 15 milliseconds, and there's a bank somewhere, either in New York or in Singapore or some other place, that has the computers, they're just watching it, and then it happens, and boom, 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 they do it. But this gives you an argument for why these equations should exist. Because any time that any of those four prices, or an interest rate is a form of price, anytime that these four prices deviate away from that equation, then the bank's computers jump in and bring it back into that equilibrium, because they love making that little bit of money. And almost every bank that has a trading desk, a lot of them have been doing these kinds of arbitrage things over the years. So yeah, it's, to be more technical, the arbitrage has to exist after transaction cost. But in reality, for the banks, they don't really have the transaction cost, so the arbitrage relationship's even tighter than you think. Yeah.
For it to be riskless, like where we're investing at the 5%, is that riskless because it's so quick that?
No, that's the risk-free rate. So that would be now remember that this is theory, right? I'm teaching you theory, and theory is not quite, like you brought it up, exactly the same in the real world. It's always a little bit more messy in the real world. A bit of the weakness here is that you assume that you can borrow at the risk-free rate in your home country, which might not always be true. But you certainly can invest in the risk-free rate in a foreign country, right? You just buy a 1-year T-bill that's from the government of England. England's not going to go bankrupt in a year. That's a riskless investment. So I actually had done that example last week. We'll put up the YouTube video probably tomorrow. But I just left it here to remind you, when it comes time to write the final exam, and you're dealing with these kinds of things, because we have the exact relationship and the approximate relationship, when you have a question like this, this is the word you have to be looking for. Does it say approximate, anywhere in the question, or does it say exact anywhere in the question? If it doesn't say anything, assume that it's exact, but if it says approximately what it should be, then you use the approximate equation. They're not that far apart. Last time I was a little bit too tight for time, but this time I have enough time. I'm going to do this one for both the approximate and the exact, and you'll see they're not that far apart. So if I use the approximate relationship, so it's this one here. I just took the bottom one, but just the spot rate is on the left-hand side of the equation in this case. Then this is remember what I call intermediate. It's not just plug in the numbers, because what you're looking for is what's HKD? Sorry, this should be GBP. what we're looking for is what is the risk-free rate, what is RGBP. So we'll just rewrite that equation as RGBP is equal to F1 divided by S0 minus 1 plus RCAD. So basically what we did is just kept this on that side, brought the 1 and the minus RCAD to this side. And we can plug in the numbers. So you can see that the exact answer, because if you did that question in an exam, you would have to use the exact relationship because it doesn't say approximately anywhere in the question. But I just did it using the approximate equation, and you can tell that it's not that far off. It gets the first 2 digits right. Just the error between the exact and the approximate is on the order of, single digit in percentages, somewhere in the order of 1 to 10%, or on the order of a basis point. And so you'll see a little bit later, it's actually on the assignment 2, where what I did is I put a question where you do a capital budgeting project using the approximate equations and then using the exact. And what you'll see is that when you have the home and the foreign approach, if you're using the exact, you should get to the same number. Anyway, so this is how you would do it wrong because it asked exact, and this is what you would get if you did it using the approximate equation. If you did it using instead the exact relationship, then now what we got to do is solve that equation for RGBP before we can start plugging in the numbers. So we have 1 plus RGBP is equal to F1 divided by S0 multiplied by 1 plus RCAD. And then you can just take, I won't write a whole second line, but you just take that 1 and you move it over here. And so you get So you can see that when you use the proper exact equation, exact parity relationship, then you get the exact answer. Next, so that was, why do we have this relationship? Because it's actually this equation. It's actually quite important. The next one is that the forward rates should be what the expected value of the spot rate. So if I have the 3-year forward rate, that should be what the market expects the spot rate to be 3 years from now. If it's not, then in this case here, you don't have an arbitrage relationship, but what you have is this. If the forward rate is higher than what you expect the spot rate to be, then people will will only trade in the spot market. In other words, if the spot market and the forward market are not in balance, then people will prefer to trade with the one that's cheaper. And by that force, it will bring it back into equilibrium. Except that you don't have the arbitrage argument, so it's not as theoretical why that exists, but it's just kind of a common sense that if the forward rate, say a year from now, is different than people expect what the spot rate to be, then somebody is getting screwed on that trade. And so what's going to happen is people are going to gravitate towards the one that's better for them, and that's going to bring them back into equilibrium. So the equilibrium here, the unbiased forward rate, is that the 1 year forward rate should be equal to what the expected value of the spot rate a year from now is going to be. So we have purchasing power parity, which is a relationship between the spot rate, the expected spot rate in the future, and what the spread between the two inflations are. Then I just showed you why interest rate parity exists. That's the, by the way, the approximate relationship here. In reality, like when you go and you get a job out in the real world, whether you're going to use the exact or the approximate doesn't really matter that much, because it's putting a small error in the third digit of your estimate. And so if you're doing a capital budgeting analysis and you use exact versus approximate, and one of them comes at 1.36 million and the other one comes at 1.32 million, it's not like the approximate's going to give you a different qualitative answer than the exact. So people prefer to use the approximate because it's a little bit quicker, but it's only introducing an error of less than 10% in your estimate. And plus, in the net present value analysis, this is a statistical estimate anyway. So when you combine those three things, you end up with uncovered interest parity, which is how is the expected spot rate in the future related to the spot rate today and the spread between the risk-free rate in the foreign currency and the risk-free rate in home currency. So I had done that example last week. The other one is the international Fisher effect. If you take the nominal rate, big R, remember, let me remind you what the domestic Fisher effect was from 2504. It was that the nominal rate is equal to the real rate plus, well, really times inflation. One thing you have to understand about interest rates and also growth rates is that it's a multiplicative relation between the two. Right? Think of if you have an investment that does 10% 1 year and then 5% the next year, it's not 15% of what you started with, right? It's 1.10 times 1.05. So when you have rates, this is the relationship between the nominal, the real, and the inflation. So a nominal rate, a risk-free rate, has part of it has a compensation for inflation, and another part of it is the real return that you're making on this. You can rewrite this as 1 plus R plus H plus RH. This is very, very small. Because, you have, say, 5% and say, 2%. And then here you have, 2% of 5%. And so in general, you can rewrite this as 1 plus R plus H. And so if you just take out the 1, you have that a nominal rate is about equal to the real rate plus the inflation. Conceptually, that's what people think out in the world. The actual real relationship is the one at the top, but the difference here between the approximate and the exact is very, very small. So the reason why I want to do this, to show you the domestic Fisher effects, is so you would understand what this big R and H is. What that's saying here is when you have RCAD minus HCAD is equal to R in the risk-free rate in the foreign country minus the inflation in the foreign country, that's the same as saying the real rate of return remember, nominal is a capital R and real is the small r. So the real rate of return should be constant between two countries. In other words, if you have two countries where you can both invest into them risk-free and one of them gives you a higher real return, what's going to happen? Somebody answer me? If you can get a higher real rate of return in country A versus country B, what are investors going to do? Yeah, they're all going to go to A. What's going to happen is if they're all investing, if they're all buying bonds into the country with the higher real rate of return, that's going to raise the price of the bonds and it's going to lower. Remember that price and yields are opposite. So if the real rate of return is higher in one country versus the other, then people will buy bonds in the country with the higher real rate of return. That will increase bond prices because you have more buying than selling, economics 101. By raising the bond prices, that's the same as lowering the interest rate, and therefore people will just keep investing in that country up until you're back into that equilibrium. You don't have this is another case where you don't have a pure arbitrage relationship, but this is something that would happen over time. And in that case, the thing that's similar to the arbitrage relationship is what's called the carry trade. You might have heard before. So whenever one country tries to keep their real interest rates, unusually low, a good example of that was Japan for the last 10 years. And so what happens is people borrow in Japan and invest somewhere else. And it's called the carry trade. So that's the international Fisher effect. We're also going to need this. We're not doing all this stuff just, for the fun of it. The reason why we need all these things is to get into the next part now, which is, I did that example last week, is to get into, okay, I'm looking at a capital budgeting project where I want to figure out what is the net present value. But the cash flows are happening in a different currency. And so how do I calculate a net present value in my home currency? There's two ways, the home currency approach and the foreign currency approach. I'll just tell you quickly, the home currency approach it's a little bit more complicated. It's a little bit more work because what you do is you take every cash flow that you have and you convert them using the forward rates and then you do the net present value. So what you do is you convert every cash flow in your analysis into your home currency, and then you do the net present value in your home currency. The foreign currency approach is the opposite. What you do is you do all the calculation, all your cash flows in the foreign currency, you do the net present value in the foreign currency, and then once you have that net present value in the foreign currency, you just convert it to your home currency using the spot rate. So those are two methods, and I'm going to show you plenty of examples of both. So in the home currency approach, first you estimate the cash flows in the foreign currency. Usually that's given to you as part of a question, but say you were doing this at a job. And you estimate the future exchange rate using the uncovered interest parity. Then you convert those future cash flows back to your home currency and you discount using, here's another point. When you do your net present value, calculation, remember that you need a discount rate for that. And so when you're in the home currency, what you do is you convert all those cash flows to those future cash flows into your home currency, and then you discount at the rate that's appropriate in your home currency. When you're doing the foreign currency approach, what you got to do is use what the discount rate in that foreign country would be. Because if you're discounting Canadian dollars, you got to discount it using a Canadian rate. If you're discounting Japanese yen, you can't take a bunch of cash flows in yen and discount them using a Canadian discount rate. What you got to do is take the foreign cash flows in yen, discount them using a yen discount rate, and then convert at the spot to Canadian dollars. So let me do a few examples. It should be usually more clear after an example or two. So the first one, you have a project that costs 9 million pesos, so that's an outflow to start with, and then you receive 2.25 million pesos per year for 5 years. The spot rate is 9.08, and the risk-free rate in Canada and Mexico are 4% and 8%. So should the company make the investment? So we have to figure out what is the net present value of this investment in Canadian dollars. So we're going to do it using the home currency approach, which first estimate the cash flows that is just given to us. So we have minus 9 million pesos to start with, and then year 1 to 5 is 2.25 million pesos. Remember, I like to use the currency codes, the ISO currency code. So that's the 3-letter code for pesos. MX for Mexico and P for pesos. So next, I don't have it here, but you want to figure out the future exchange rates. So what is going to be the spot rate 1 year from now? You have the equation I'm going to do it on 2 lines. Then I'll have to. So the spot rate right now is 9.08. And then we multiply that by 1 plus 0.08 minus 0.04. And so the spot rate a year from now is going to be 9.4432 Mexican pesos per Canadian dollar. Now remember, we have 5 years. So it's a little bit time consuming, but we got to figure out what the rates are going to be for each one of those years. So then I wrote the formula here. You got in an exam, you got to write it at least once, but you know we'll be lenient so that you know when you repeat it a second time, you don't have to keep saying the formula again. But at least that you showed us that you understand that's a formula that's going on here. So then the second time, you're going to have 908, which is the spot rate, and then you're going to have 1.04, but now it's squared, because remember that the equation for the expected spot rate t years from now is the same, but then the bracket here is to the power of t. Now the power of t is to the 1 plus the 2. It's not just t. I've seen people make that mistake, students make that mistake where they put the t on just the difference between that and then they do 1 plus that. It's 1 plus the difference between the rate, and all of that is to the second power. So 9.08 to 1 times 104 squared. So the if you're converting a cash flow that occurs in 2 years, then you'll do it at this rate. Then just keep going. The spot rate 3 years from now is going to be 10.2138. So which currency is at a forward premium here? Oh, sorry, I'm not click on that. Which currency is at a forward premium? If the risk-free rate in Canada is 4% and in Mexico it's 8%, which one of the two currencies is losing its purchasing power quicker? Yeah, yeah. So that currency would be at a forward premium or a discount? Yeah. The currency that's losing its purchasing power faster is the one that's at a discount. So you can tell here that the Canadian dollar is at a forward premium to the Mexican pesos because of you can see it from the difference in exchange in risk-free rates, and so you can see that over time, the exchange rate in terms of how many Mexican pesos you need to get 1 Canadian dollar gets higher and higher. In other words, what's happening here over time is that the Canadian dollar is strengthening and the Mexican pesos is weakening. Because of that, remember that the relative purchasing power parity into the future is what makes exchange rates move. The exchange rates are based on the expectation of future inflation between the two countries going forward. Now, if you just keep doing that. So the first time you do it with power 1, then the second time power 2, then the second time power 3. I'll just write out the so we have 6 cash flows. We have the cash flow today, and then cash flow for year 1 to 5. So the cash flow today is going to be converted at the spot rate. Then the cash flow a year from now is going to be converted at the expected spot rate a year from now, and then the cash flow 2 years from now at the the expected spot rate 2 years from now, and so on. So now, so that's your ES1, ES2, ES3, and so on. So the cash flow in year 0, which is minus 9 million Mexican pesos, that's going to be converted at the spot rate. And when you do this type of question, it's very useful to have, to actually write the, what currency that amount is, because it's pretty easy to get confused, especially if you're dealing with currencies which are a little bit closer than those two. It's easier to, do I have an amount in Canadian dollar or US dollar? So it's a lot easier to make sure you don't make any mistakes to use your currency codes properly. So then, cash flow in year 1 is going to be 2.25 million Mexican pesos. And now, you're going to be converting it at the spot rate a year from now. Because you're going to make 2.25 million Mexican pesos a year from now. So you're going to be able to convert that 2.25 at the spot rate a year from now. Then the 2.25 million pesos that you make in the second year is going to be worth less, because 2 years from now you're going to be converting it at a rate which is stronger in Canadian dollars. So here I have 1. So the cash flow 2 years from now is going to be converted at the and so on. So I'll just, so then the cash flow in year 3. So basically what you do is you just keep doing that for each year. So then the cash flow in year 3 is going to be 220T, 291. And then the cash flow in year 4, 211, 818. Cash flow in year 5, 203, 671. So now, you now have the cash flows, or the cash flow estimates. And now you can discount using the domestic return. So you know the domestic return, the dollar required return, or the Canadian discount rate is 15. So what you're going to do is the net present value in Canadian dollars is going to be the sum and so you just write the whole, I'll skip the writing the cat at each one now, but you know you're in, so it's 189 plus 238, 267 divided by 115 plus 229, 103. Discounted back 2 years, plus 220, 291, discounted back 3 years, plus 211, 818, discounted back 4 years. And so the net present value is negative. Therefore, should the company make the investment? What do you think? Who thinks no? All right, the rest are wrong. So you have a negative net present value, and therefore the company should not make the investment. So you can see that doing capital budgeting in a foreign currency is a lot more tedious than doing it in where everything's in your home currency. Just in general, that's why, you know, if you're an accountant in a global business, currencies is a huge headache because the numbers are constantly moving around. So there's lots of businesses that, you know, a lot of their earnings from quarter to quarter has to do with what currencies are doing based on what country they're based in, where a lot of their sales or a lot of their growth is coming from. So that's how you do the home currency approach. And if you missed some parts, you can download the notes from my website or from CU Learn. So next I'm going to show you, we started at 6:50. Who wants a break now? Okay, so we'll do a foreign currency approach, and then we'll take a break after that. So in the foreign currency approach, what you do is instead of having to figure out all those expected spot rates in the future and having to convert every single cash flow into the home currency and then discount, what you do is you still have to estimate the cash flows. That's, like I said, that's if you're doing this as a job. Because as an exam, you're just told, these are the cash flows going to be, so you're not actually figuring them out. Then you use the international Fisher effect to convert the required return that you had from your home country to what the foreign discount rate should be. Now, maybe you're just given, you're told the discount rate's 15 in Canada and it's like 10 in Japan or something like that. But if you're not given what that discount rate is, how do you figure it out? Well, you use the international Fisher effect, that the real rate of return should be the same between two countries. And so what you do is you take the domestic discount rate, and then you figure out what the spread above the risk-free rate is, and then it should be the same in the other country. Then what you do is, this one's actually quite a bit simpler, because instead of having to figure out all the rates for each year of your forecast period, have to convert everything. The only complication really is to figure out what rate you're going to use, because you're not going to discount Japanese yen using a Canadian discount rate. That makes no sense. So you have to discount, you're discounting all the cash flows in the foreign, you're still keeping everything in the foreign currency. It's just that the only really mathematical difficulty here is that you got to figure out what is the discount rate that you're going to use in your net present value calculation while you're doing it in the foreign currency. You discount, then you get a net present value in the foreign currency, and then you just remember that a net present value is an amount of money today. Right? It's called present value. And so if you just convert that using the spot rate, you have your net present value in the home currency. So here's an example. Oh, actually, that's the same example continuing from the previous slide. So let me just redo that part to be perfectly clear what's going on with that first line there. Remember that you have RCAD minus HCAD. Well, you can rewrite it in a different way. You're given the risk-free rate and then the discount rate. What could I use for? Maybe I'll use K as another. So the discount rate in your home country, the spread above the risk-free rate should be equal to the discount rate in the foreign country minus the risk-free rate. It's the same principle as the international Fisher effect, but there's just a slight so the Mexican inflation rate's 2%, and the required return is 15 plus 4. Here's a little more formal, clear way of writing this out. Keep that on that side. So you have KCAD minus RCAD plus RMXP. So the discount is 15, and the Canadian rate is 4. So that's when it comes to doing a foreign currency capital budgeting or net present value. That's really where everybody trips up. They can't, either they just use the Canadian discount rate, or they just mangle it and try to figure out some kind of rate. But here's the very simple way to write it out. Right? The inflation rate is 4%, and so you add up 4% on top of the Canadian rate to get. If you're discounting cash flows into a weaker currency, then you're going to be using a higher discount rate because there's more risk there. So the present value of the future cash flows. In that case, that would be the present value of, that's just the 2.25 for 5 years at 19%. So what's the equation for that? Remember, it's payment, and then you have the 1 minus 1 plus r minus t over r. And so that's going to be 2.25 million 1 minus 1.19 to the minus 5 over 0.19 will be equal to 6,879,679. And remember, that's an amount in pesos. So the net present value is going to be the present value of the inflows minus the original outflow. So the net present value is minus 2.1 million pesos, and then you just convert that at the spot rate. So in other words, the way you finish this question is you want to know what is the net present value in Canadian dollars. So what you do is you take the net present value in foreign, and then you multiply by the spot rate. And so the net present value in the foreign currency is minus 2,120, 321 pesos. And here's where using the codes, the currency codes, comes in quite handy. You know you got to do something with the spot rate, which is 9.08. Do I multiply? Do I divide? Well, just think of, I have 9.08 Mexican pesos for 1 Canadian dollar. So this cancels out, and I end up with an answer in Canadian dollar, which I was expecting. If you put it the other way, and you multiply it by 9.08, then you end up with an answer in Mexican pesos squared divided by Canadian dollar, which makes no sense. So this little trick, it's not in the textbook, but this is something I've come up with teaching the course over the years. It just makes it a lot easier to make sure that you don't flip a number in the wrong spot. So imagine you did all of this, and then in the end you multiply by 9.08 instead of dividing, you just blew out your answer. Of course, you still get pretty decent part marks, but might as well finish and get the full marks. So I end up with an answer in Canadian dollars. Now you can see that, what's the answer? Minus 233,516. The previous time, oh, I didn't have it on there, but it was minus 243. So you can tell that by using approximate rates, you were only wrong in the second answer. In the second digit. In assignment 2, there is one where I make you do a question like this using approximate and exact for foreign and home. And what the hint is that when you do exact for foreign and home, you should be getting to the same answer. But in general, home currency and foreign currency, when you're using the approximate interest rate parity equation, you'll get pretty close, minus 233 versus minus 243. You still end up with the same net present value decision. Okay, here's a good place to take a break. I'll do one more example afterwards. Actually, that's an example of the foreign currency approach. And then I have a couple of slides on qualitative knowledge. So it's 8:05. We'll take 10 minutes or however long it takes me to go to Dumpton Tower and back. And then we'll start again. So this is another example of the foreign currency approach. So we have, remember that, well, the first step is figuring out what the cash flows in the foreign currency are, but that's just given. You got a negative 2.3 million Australian dollars to start up, and then you bring in 950,000 Australian dollars for 3 years. The project will be worthless after the first 3 years. The reason why that is think of discounted cash flow valuation, where you have a forecast period and you discount those cash flows individually, and then at the end of the period you now have something that's worth something. The example is the supernormal growth stock model from 2504, where you discount the dividends for year 1, 2, 3, 4, 5, say, and then at year 5 you then have a stock going forward that has value. So that's another cash flow that's called the terminal value. In this case, what this is saying is you start up a business, it costs you 2.3 million to start it. It brings in 950 a year, but after the end of 3 years, it's over. Normally, what actually happens is you have a business, you start it, and then it keeps going after that. But it's just made simpler by saying that's what the sentence be worthless after the first 3 years, meaning there's no terminal value on that investment. Then you have the expected inflation rate in Canada, in Australia, and Canada. So here, which of these currencies is going to be at a forward premium? Exactly. The inflation rate's higher in Australia, so the value of the Australian dollar is losing its purchasing power parity. It's losing its purchasing power faster than the Canadian dollar. So when you look at going into the future, a Canadian dollar is going to be worth more relative to the Australian dollars a year from now, 2 years from now, 3 years from now, and so on. So if you have the required return in Canada is 6, but the spread of inflation between the two is, you have a spread between 5 and 2, then you get, in this case, it's given to you relative to the inflation rate. But what you can just do when it's given to you relative to the risk-free rate, it's still the same concept. What you do is you figure out what is the spread above or below what your domestic currency is, and then you just add it on to what your domestic discount rate is. But you can just write it this way. RCAD minus HCAD is equal to, so the 3-letter code for Australian dollars, AUD for Australia dollar. And so now, the next part is to figure out what the net present value in the foreign currency is. Now those cash flows are the Australian dollar cash flows. So this you could easily do, you got to write out the formula, then the formula with the variables, then the formula with the numbers plugged in, and then the answer. But if you're doing this and you have your financial calculator, it's super easy to do this quickly. You go cash flow, and then second clear work. Remember to always clear work when you do these things, because if you did a problem before that had 5 cash flows, and then you do another one that has, it's really 1 because it's repeated, and you don't do clear work, then the crud from your previous problem is going to stay there. So every time you start a problem with the calculator, you got to remember to do the clear work thing. This is just CF0 is minus 2.3 million, C01 is 950,000, and frequency 1 is 3. I is 9%, compute net present value. And that gives you 104,730 Australian dollars. So now you want to know what is the net present value in Canadian dollars. It's going to be the net present value in the foreign currency, in this case Australian, times the spot rate. Now you're going to say, well, what's the point of even converting it to the home currency? Because we know that if we have a present value, a net present value that's positive in a foreign currency, obviously when you translate it to Canadian dollar, it's also going to be positive. But could someone give me maybe an example why you do care what the actual number in Canadian dollars is? Or other countries. Say you're a Canadian-based company and you have 5 possible investments. One of them's in Australia, one of them's in Japan, and one of them's in Canada. And then you have 2 more that say have negative net present value. So you know you're not going to do those, but you only want to do, say, 1 or 2. How do you pick? Well, if you had that, I have one potential investment that's 104 Australian dollars, I have another potential investment that's 1.2 million yen, and I have another investment which is 50 Canadian dollars. I mean, how do I rank those? So that's would be a reason why it's actually worth it to bring everything to the home currency so that you can rank your projects in descending order net present value and then start with the one at the top. So for the rest of the chapter, it's pretty easy. We're done with the heavy math stuff. So the rest is just qualitative knowledge. So let me just make a few comments, but you can read the slides, and you can also, for this part, I guess that's 21.5 or 21.5.6.7. I think I skipped .6. .7, .8. You can read those in your textbook, but let me just make a few quick comments. Sometimes some of the cash generated from a foreign project has to remain in the foreign country due to restrictions on repatriation. These could be actual capital controls. So an example, the two countries that are doing that right now are China and Brazil. China is trying to stop money from leaving China, and Brazil is trying to stop money from coming into Brazil. So they have different reasons for restricting or putting in these policies that maybe tax the international flows or something like this. Another reason that cash would remain in a foreign country would be, think of a global company, but that's headquartered in the U.S. You hear that over and over again. American corporations have $3 trillion of cash on their balance sheet. Well, most of that cash is not actually in a bank account in like New York or New Jersey or Chicago. They have operations in all their foreign countries. They make all their profit in these foreign countries. But because the U.S. doesn't have what's called a territorial tax system, where the usual tax treaty between countries is what's called a territorial. So if you have a multinational company, will get taxed on their income just in the country where that income occurred. U.S. is one of the only ones where what they do is, if you have a company that's headquartered in the U.S. and they make money in a foreign country, they have to pay tax in that foreign country and then still pay tax also to the U.S. government. And so that has created they don't pay the full thing because you get a credit for it. It's complicated. If you want to be an international tax accountant, there's a job for you forever. So that's what's happening with the U.S. The actual repatriation, meaning bringing the cash home, there's these taxes in the way and some other things. You can shift money. Now, this is what the textbook says, but I'm telling you, the companies have become way more creative on how to set up these structures I wouldn't say evade tax, because they're not. There's a fine line between tax planning, which is legal, which is to take the maximum advantage of the tax law, and then tax evasion, which is willfully, kind of with criminal intent, not pay your taxes. But there's lots and lots of schemes and things you can do. Usually, the classic model would be that you have country subsidiaries. So you have, say, a CanCo, which has a parent company, say US Co, or let's call it this way. This is a structure you could have. And then you would set up this corporation in a jurisdiction where it has a very low tax. And then you have in a way, this is a holding company, and these are operating companies. Same thing. So these companies are actually, run businesses. They do things. They sell things for $10 that they paid $5 for. They make money, and then they kick up their profits in dividends up to the top company. So that's what dividends to parent company is. Another way is what are called management fees. So what you have is the whole world co, or call it parent co. What it does is it charges, instead of these companies having their sales minus their expenses get their income, and then out of that you pay the dividends. Another thing that companies do is the parent company charges the operating company for management, a management fee. So it could be that the CanCo has as an expense $1 million a year that it pays WorldCo to take care, say, of at the parent holding company, you'll have all the corporate-wide costs. So you'd have, the accounting department, maybe marketing is globalized, maybe marketing is in the local places. You'll have IT and so on. Another way is royalties. So you could have, say, example, I have a company. Say, what's the company that makes the jackets? What is it called? The Canada Goose. So you have Canada Goose. So the company say that's selling Canada Goose jacket in the U.S. What they would do is pay a royalty to the parent company in Canada as a percentage of sales. So if they sell, 10 million, they pay, let's say, 1 million. If they sell, say, 25 million, they pay 2.5, and so on. Say a 10% royalty. Those are three of the ways that can happen, but trust me, tax accountants have come up with way more creative way of doing this. Now, when you run a business that's facing exchange rates like that, you have some risk in case things move back and forth. So that's called transaction exposure. You're exposed to, if I have a company, say, that owns real estate all over the world, and it has, rents, makes rent like 1 million per country per year. Well, if the exchange rate goes up and down, that actual money that comes home is going to change over time, right? That's what transaction exposure is that over long periods of time, and I told you the story, I think, last week on how my first ever business got killed on the euro and the British pound went up and the US dollar went down, so my margin got squeezed from both sides to the point that I wasn't making any more money anymore, and ended up selling it to a British guy. But that's why companies care about derivatives and swaps, is because they can protect their forward profits. If they know they're going to make a certain amount of money, and then they lock in a derivative trade, so a swap or a forward contract, then they know they locked in how much money they're going to receive 6 months from now, a year from now. This is especially important in countries where there's quite a bit of upheaval and the currency could go up and down like a yo-yo. There are other things that can influence currencies. Some of those are more difficult to hedge, especially when you go into very long dated. You might be able to hedge your inflow, say, a year or 2 years or 3 years from now, but there's so many things that can happen in a country and an economy over 5 years that if there are derivative contracts out there where you could hedge those currency flows way into the future, the cost is way too high. So in general, what you want is you want to match the inflows and the outflows in the same currency as much as you can. This has to do more with accounting. I was saying that before, and accounting regulations, you're not going to be tested on those, but they're actually, quite complicated, and I think that with IFRS they got even a little more complicated. You'll see something. I don't know, the way that I used to do it when I had my record store. It was gain and loss on foreign exchange or something like that. That was one of the line in the income statement. But just here's an example of how things can get complicated. Just very simple, and we'll move on. Say you're due net 30 days accounts receivable. Right, so I have an invoice that's as of say June 30th. I owe 100,000 British pounds. Well, or say no, I'm receiving 100,000. So I issue an invoice. So I book the revenue for 100,000 pounds on that day. And say the exchange rate was 0.8, so that's the equivalent as 80,000 Canadian dollars. Now, 30 days later, when I get the payment on that invoice, the exchange rate's not the same anymore. So I'll still receive a check for £100,000, but when I deposit in a bank, I might get 82,000 Canadian dollars. I might get 81,000 Canadian dollars. I might get, 78,500 Canadian dollars for that 100,000. So it creates, even just on an accounts receivable over 30 days, it can make things quite complicated. This is more of an accounting issue. I'm sure that if you do international accounting, you'll have plenty of fun with that stuff. So how do you manage the exchange rate risk? What you do is you look at your net exposure, meaning that, if you know that you receive 100,000, say every year from a foreign country, but your costs are roughly 80,000 each year, then what you're going to do is not hedge the full 100. You're going to hedge what your actual net exposure is of 20. So that's what net exposure there means. Now, sometimes hedging individual currencies can be expensive. There's a whole part of finance which is trading derivatives and managing currencies and this and that, and you'll learn a lot more about that in third and fourth year. Now, political risk. That's the last slide. That is, I would say, impossible to define, right? Because politicians, they come and go very quickly. Sometimes you think that, you got one government in a country, and they give you a 10-year license to operate a mine. Things are, everything's doing well, and you set up, you bring in employees, you make investments, and then, 6 months later or 2 years later, there's a coup, and next thing you know, you're in your office at the mine, and the army shows up, and they put a gun in your face and say, "Get out! This mine is ours now." You got to be in some foreign countries. You have an incredible amount of political risk. Take in current events, Cyprus. There's Russians that were putting their money in there in case something bad went in Russia, and it ended up being something bad's going to happen to their money deposited in Cyprus. Probably what they're talking about is the amount of money that's above the deposit insurance. They'll probably lose 40%, 50% of it. So if say you have 200,000 in euros in a Cyprus bank right now, within a week or two, you'll only have 150,000. So there's lots that could be said about political risk, and I could give you a big, huge rant about how bad politicians are for business and how much risk they introduce. But you can kind of look at it and know that it exists, but it's not like currency risk where you have all these tools where you can hedge and measure and protect and forecast. These are just, it's the difference between a known uncertainty and an unknown uncertainty. It's so vague, it's impossible to put numbers on, but be aware that it exists. So, that's it. For the more examples, you can try them yourself at home. And the solutions for them are on the notes, which are posted on lemma.ca and CU Learn.